If everyone would please move towards their seats, silence your cell phones. I will call this first meeting of the Interim Joint Committee on Banking and Insurance to order. We do have a full agenda, so we'll start moving just right in that direction. Madam Secretary, if you would, please call the roll.
Senator Rocky Adams. Senator Chambers Armstrong. Senator Douglas.
Present.
Senator Elkins.
Present.
Senator Girdler. Here. Senator Howell. Here. Senator Rawlings. Senator Smith. Senator Storm. Senator Yates. Representative All. Here. Representative Bauman. Present. Representative Bray. Representative Camuel.
Here.
Representative Klines. Representative Duval.
Here.
Representative Gooch.
Here.
Representative Gordon.
Here.
Representative Grossberg. Representative Hampton. Representative Hancock.
Here. Hampton's here. Sorry.
Yes. Representative Heverin.
Here.
Representative Lewis. Representative Lockett. Representative McPherson.
Here.
Representative Pollock.
Here.
Representative Rudy. Present. Representative Smith.
Yes.
Co-Chair Carpenter. Co-Chair Meredith.
Yes, ma'am. We do have a quorum and are duly constituted to do business today. We minutes to approve for this meeting, since this is the first meeting of the interim. Do want to welcome our new committee assistant, Miss Sasha Allen, to the committee. Sasha's been around for quite a while, but new to our committee, so welcome to her. Do have a guest to recognize. If anybody else has guests, let me know. But Representative All, we'll start with you.
Thank you, Mr. Chairman. I'd like to introduce Ms. Storm Spears. Ms. Storm is with me today. She is a legislative intern for me this fall. She's from Flemingsburg, Kentucky. That's her hometown, and she's a marketing and pre-law sophomore at the University of Kentucky. And her fun fact is that she's a student worker for operations at Kroger Field this fall for football. So if you need help getting in, you have problems, you see Storm, she'll take care of you at the football games. So please welcome Storm.
Storm, welcome to the committee this morning. Any other members have guests they'd like to recognize? Seeing none, we will go straight into the agenda. I'm going to call first the Kentucky banking industry update. Tim Schenck, John Cooper, come up. Please introduce yourself for the record, and then you all may proceed with your presentation.
Tim Schenck, Kentucky Bankers Association.
John Cooper, Kentucky Bankers Association.
Good morning, members of the committee. Thank you, Mr. Chairman, for your time here today. First, I wanted to come off and thank you all for a great 2025 session. There were a number of negative bills that could have really impacted the banking industry, but those did not pass, and we appreciate your support through the 2025 session. First, I wanted to talk about a little bit just things we're going to cover today. We're going to talk a little bit about housing, and I want to apologize in advance for those of you all that are on the Joint Housing Task Force, as you may have heard some of this already, and I'll try to be brief with it. But this is really important to the bankers and a key priority for us, so we wanted to talk a little bit about an initiative that we proposed to that group and talk about how important that is for the bankers. Really briefly, we'll talk about new market tax credits and historical tax credits, and then a little bit about credit unions. As you all are aware, for you all that are on the Joint Housing Task Force, we have a huge housing crisis right now. And Kentucky Housing did a great survey and study, and it can go into really great detail. But in short, as of 2024, their study showed we were about 206,000 doors short. As this has progressed with the Joint Housing Task Force, whether that number is 250,000 doors short or where that lies in between, either which way, we have a huge Kentucky housing crisis. And we've got to find a way to get through it. When we're taking a look at the supply gap, the thing that strikes out to me on this group is that you can see that the housing need is in all 120 counties. Certainly it's larger in Lexington and Fayette and Jefferson, but there's not a county that doesn't list a housing gap on this map. And when you're looking at adjusted median income based off of census tract, 80% or 70% of those in need are under the 80% mark of their area median income. So you're thinking of where the need is. It's on low low to moderate income, but also workforce housing, which is the piece that we really are talking about from our perspective. Again, looking at this same map here, you can see it again, but this is just the numbers for Jefferson and Fayette. But when we take a look at a number of your all's counties that you serve on here, a lot of counties that may not get attention on the housing crisis have significant housing needs. Looking at counties like Hardin County, over almost 5,000 homes. McCracken, almost 4,000 homes. Shelby, almost 2,000. I mean, these are real shortages that are pervasive throughout the Commonwealth, and something we have to tackle. From a banker's perspective, one of the things that we pay close attention to is talking about workforce housing, and I think that there's no better example than Rowan County. So when you think of Rowan County, it houses Moorhead State University, a great hospital. But when you look at their percentages on shortage of housing, they're 12% short on housing. So when you talk about university professors and those nurses working at the hospital, sometimes having to commute an hour and a half, an hour to get to their job, that's just not efficient. And that's a real problem. But Rowan County is a great county in our Commonwealth with a lot going on, a lot of development, but also with a lot of housing needs. So we need to find a way to tackle that. When we talk about problems in the housing area, the National Association of Home Builders did a really nice study, and they talked about what was in 2024, but looking at 2025, the two biggest areas that they cited as threats or challenges for them in the industry were based off interest rates, high interest rates, and that buyers expected interest rates to decline. And that's where, as a banking industry, we feel like we're uniquely suited to be able to help in the housing crisis. As obviously we can control interest rates to a degree. We're not the Federal Reserve, but through some incentives and other things, we can help incentivize some housing projects, which we'll talk about here really quickly. The solution that we proposed, and I know a number of you all have heard this, but in short, we have $20 million pledged from the bankers to address the housing crisis. And when we talk about this in a little bit more detail, in short, it's $20 million with a proposal to be backed with $20 million in tax credits on the back end. And this is creating new housing. This isn't refinancing of existing doors or some other things. This is creating new housing. So we know that if we're going to tap into the housing crisis, we have to put up new forms of housing. And one thing that I'll point out, which we talked about last week with a number of stakeholders on KET, is that I think one of the things that's really nice about this proposal is that it's flexible. It's a blind fund. So we'll talk a little bit about the regulatory piece from it from a banking perspective, but the $20 million can go to any community, and the bankers don't have a say, and there's a reason for that. But it's built off of being a revolving fund, and it can create things like manufactured housing. 10 years ago, manufactured housing was looked at as an inferior form of housing, but it's come a long way. And if we're going to take a big dent into the housing crisis, we have to look at some alternative options outside of traditional brick and mortar. And I know if Chairman Carpenter was here, he would tell me, it's cheaper for him in degrees to build a $500,000 house or a $600,000 house rather than a $200,000 house. So those are some of the issues that we have in terms of a housing crisis. Details on program administration. Hope of the Midwest, and actually the numbers now usurped $800 million, but they built over $800 million in affordable housing over the last 15 years with a zero default rate. So a lot of experience in this. But when you talk about the types of projects they've done it throughout the Commonwealth in all different communities in all different forms. So some of that's revitalizing historical historical pieces, and you've seen that in West Louisville and South Louisville, but then a lot of this is rural development. So a lot of ability to move out there. When you talk about the way that the project works from an administrative perspective, part of the way that the tax credits kick in is that, in short, it will drop target rents down by about 15%. So when you think of a 15% impact on reduced rental rates, that gap on cost can cover things like utilities, all the other expenses that go through that, and make it much more affordable for those across the spectrum. We talked a little bit about the bank funding and the $20 million commitment. And again, these loans will be provided at below market rates. And we'll talk about the reasoning coming up on why banks are doing this. But obviously, first is being good citizens of the Commonwealth. But in short, it's revolving because the funds will be repaid by the developer as the projects are completed with an evergreen fund and the opportunity to increase. We've talked to a number of you all about this project and its flexibility and its the long-term sustainability of this program. But the concept is that this can continue to grow, but repaid and continue to impact every area of the Commonwealth. When we talk about the tax credits, one of the things that's really critical here is that the tax credits would be earned over a 5-year period, but none of the tax credits under the proposal would kick in until doors are completed. So when we talk about traditional tax credits, a lot of those come at the front end. These would have to be doors that would be built before anything would kick in on the back end. The other part about that is that they vest over 5 years, which is for a very good reason. If you look at traditional tax credit programs, that's to ensure that you build quality housing. Because you've seen historically, sometimes if tax credits all kick in 1 year, there's not necessarily the benefit to keep it as a long-standing, well-built project. So we're talking about long-term, affordable housing that can last across the spectrum. We referenced this briefly, but the why for banks obviously is, one, the commitment to the Commonwealth, but also that banks are subject to federal law called the Community Reinvestment Act. Credit unions and others are not subject to this law. But in short, as Chairman Meredith can probably tell you, banks have a challenge with Community Reinvestment Act. It's all based off of, a lot of it's based off of metrics in working within certain areas and census tracts, but it's not the way that the federal law is constructed is it doesn't let banks necessarily deploy assets to the areas most in need. But what we've done is work really closely with the FDIC to have an understanding that by virtue of being in a blind fund, it'd be viewed essentially as an investment, and that would allow banks to deploy these assets throughout the Commonwealth. So if you think of areas that may have lower loan demand, by virtue of putting it into this fund, it can move throughout the Commonwealth, and they get the same CRA credit across the board, which is really beneficial. I know I flew through that, so I'm glad to take any questions, but I wanted to be sensitive to those that are on the Joint Housing Task Force. One of the other issues related to housing that's important to us is the new market tax credits. In 2024, that was House Bill 485. In 2025, that was House Bill 372, but we haven't passed that in the last 2 years, and traditionally that had been a bill that passes every year, so we just wanted to bring attention to that again, as new market tax credits are a really critical component of able to revitalize some communities or continue to engage with the growth. Another one that we've talked about a lot is historical tax credits. Several years ago, the carry forward was changed from 7 to 5 years. And what we found is, as supply chains have changed and some things can inhibit supply chain, it takes longer to construct some historical tax projects. And with that need is really the need to extend that carry forward back to 7 years. So when you're looking at historical tax credits, obviously historical projects have to be rebuilt and keep their structural integrity and their historical integrity intact. But at 5 years, that can be really challenging. When you talk about, there may be a lumber supply shortage from Canada or some issue that may hold up building, there's concern that project may not be completed in that 5-year time period. So our proposal essentially is part of that, which a bill was filed in 2024, was to extend that out to 7 years. And that would help a lot with having those constructed. One of the issues that we're here to talk about today is credit unions as well. I know you all are aware of some of the issues that we have with credit unions, but from a general perspective here, one of the key things that we'd like to point out is just that, they're not subject to the same tax that banks are. They only pay property tax and payroll taxes. They don't pay your income tax or your local deposit tax. Credit unions this year, they purchased a bank First State Bank of Middlesboro, and we'll talk a little bit about the financials with that. But the states around us are taking actions to ban the purchase of state chartered banks. So when you look at Tennessee, Mississippi, and West Virginia, they banned the purchase of state chartered banks. And these banks that they're purchasing, they're not struggling banks. These are healthy banks. Nearly 2/3 of them saw an increase in net operating income over the last 5 years, and their total, and more than 3 and 4 were growing in total assets. So why does this matter to the Commonwealth? Well, when you're looking at First State Bank of the Southeast, that was roughly a $400 million bank with revenue of $345,000 a year, deposits of $342,000. $342 million. I'm sorry. But here's the loss. So when you look at that purchase, these are the taxes that are now lost to the state, county, and city levels by virtue of that purchase. State taxes of roughly $205,000 are now gone. Looking at that from a local deposit level, that's roughly $140,000 of city and county tax that's gone. And when you look at it at a more granular level, Bell County will lose $50,000 in tax. Middlesboro, $31,000. Pineville, $18,500. Whitley County, $10,000. Williamsburg, $10,000. Lexington, Fayette County, $10,000. Laurel County, $4,000. London, $4,000. So these are real amounts of money that are now gone from local tax base and the Commonwealth by virtue of one purchase. And this isn't a huge bank. This is a $400 million bank. So when we talk about as these banks are acquired, how are you going to replace that to these local communities? And that, to me, the only answer would be to increase the tax if we don't put a stop to it.
One of the things we did when we moved a few years ago from the bank shares tax to the corporate income tax was we committed to local governments to keep their tax base whole, and we kept our word on that. What this does in effect is it depletes their local tax, and this may not sound like a lot of money, but those of you who come from some of these communities know that could be an ambulance, it could be a fire truck, or it could be an initiative within the local community. So we kept our commitment to the local communities, and we want to continue to do so.
And then, the other tie-in with this is that obviously, the banks paid deposit tax on this. And one of the issues that you'll hear about this upcoming session is deposits and credit unions taking deposits. And Auditor Ball has spoken out on that and said that credit unions are not able to take state deposits and local deposits, county deposits. But they've said, through an affidavit that they previously had been putting those in credit unions. And we do not believe that credit unions that don't pay tax on those deposits should be able to hold those deposits. It's just taxpayers benefited the taxpayers here. But I know that you all have a very busy agenda today. I appreciate your time, and I'm glad to accept any questions, as I know I moved really quickly through those slides.
Thank you, gentlemen. I do want to recognize that Senator Carpenter will or should be here shortly. He was running just a little bit behind this morning. There was a question about that, so I want to answer that for him. Leave it to the Senate to leave the House members waiting again. But are there any questions from members of the committee for this panel? Senator Douglas, I do see a question from you.
Thank you, Mr. Chairman. John, you or Tim, either one can answer this question for me. When was the last time we were actually caught up in terms of housing here in the Commonwealth, if ever?
I don't think we have ever been totally caught up in housing, but the problem has precipitated, and here's one of the reasons why. You probably during your recent history have seen local developments in local communities that were what we call starter homes in the old days. It was the Balls in Central Kentucky did a lot of them. There were a lot of different companies that did those. Those have gone up in price exponentially. And Senator Carpenter is the best. He's the best resource on this because he can tell you what his starter home used to cost and what it costs today, and it's about 100% more almost than what it did. And it's just a matter of affordability. One of the problems is one of the things that the General Assembly from a policy standpoint will need to look at as we tackle this, infrastructure. we have talked with a number of legislators about the fact that you can build a local development, but infrastructure needs are critical and they're expensive, and you don't get any return on those for a long time. And so that's one of the roles, in addition to the tax credits, that's one of the roles where state government from a policy standpoint can help. Senator Douglas, hope I answered your question.
You did. Mr. Chair, may I ask one more quick one?
Go ahead.
One of the things that I'm really interested in is the discussion surrounding regulations, and I know a lot of my constituents also will bring up regulations, and I know in my conversations with Senator Carpenter and with other construction persons, what they bring up in order in terms of the regulations is the fact that local, then federal, then state. And I know often we ask the state to do certain things, but one of the things they bring up to me is are the local regulations are some of the greatest barriers. Would that be? Would you say that?
That is correct, Senator. And thank you for the question. You know, when we look at some of the projects that we've worked with, even with Hope, we've had projects held up by 2 years by virtue of 2 feet of difference in a sidewalk or a number of parking spaces or things like that, you know, can change in the middle of a project, but hold it up for months. And those are the things that, you know, can really delay creating new housing across the board. But we've seen it at all different levels, and it is a challenge.
Utility easements are particularly problematic, and we had one in central Kentucky that had no utilities in the easement. It took 18 months to get the easement dismissed.
Thank you, Mr. Chairman.
Senator Rawlings.
Yes, thank you, Mr. Chair. Wouldn't it be a bad policy intervention to the private sector to prohibit credit unions? I mean, you've outlined your position on that, but as far as the free market, isn't that a bad policy intervention for us to stop business?
We think it's a matter of fairness. You know, if you are going into banking, if you're purchasing a bank, then you ought to make sure you pay the same taxes. If not, then the government basically has put you at a competitive advantage. Okay, and it's you know, as you know, Senator Rawlings, that financial services is a very competitive marketplace. And it doesn't take, there are a lot of folks in here with banking experience, it doesn't take a lot of millage to make a difference.
Well, okay, thank you.
Any other questions from members of the committee from this panel? Senator Elkins.
Thank you, Mr. Chair. John, you said something that caught my attention, and I may have misheard you or misunderstood you, but we're talking about the slide that's actually on the board now, and I think I heard you say we kept our commitment to pay those taxes. Did I hear that correctly? Or
one of the things we worked through with the local governments was to make sure when we changed the way we tax banks and took them to the corporate income tax, and that was the tax that we taxed in Kentucky was out of date, and quite frankly, we were one of the highest tax rates in the country at that time from a state standpoint. But one of the things we were asked at that time was to keep the local tax revenues equal, or keep them whole, and that's what we did. And that's what the legislation did. The legislation kept the local deposits tax, and you see those there in those communities. So that's what I was talking about. I hope I didn't mislead you.
No, sir, you did not. I was just wondering, is it a voluntary tax that you are paying, or is it regulated, or are you paying above what's required?
If I could, Senator Elkins, so several years ago, again, we moved from the state deposit tax. So banks in Kentucky paid a tax based upon the deposits that they held in their institution. Because if you analyze at a state level across the country, that tax was much higher than many other states. We moved them to the state income tax, and that followed the lowering of the state income tax as well, which had an impact on those state-by-state numbers for how banks were taxed. At that time, there could have also been an effort made to change that tax structure at the local level because banks still pay a franchise deposit tax based upon the deposits held in their institution for cities and counties if they have enacted that tax in those cities and counties. And so the banks made the commitment to the cities and counties at that time that they would not change the structure of the local tax to an occupational tax, but keep it at the deposits tax. And that's the commitment that they are talking about.
Which in turn benefits the counties or the communities.
Correct.
Yes.
Thank you, Mr. Chair. I appreciate the explanation. Thank you.
Thank you, Senator, for a thoughtful question.
Any other questions from members of the committee before we dismiss these guests? Seeing none, thank you, gentlemen, for being here. Appreciate the presentation.
Thank you, Mr. Chairman, members of the committee, and in Senator Carpenter's defense, I got in construction on 64 coming over, and we'll assume that's where he's at. Thank you.
He's happier to be in construction than in a committee meeting, I can tell you that. Commissioner Clark, our friend, if you would come forward, I am going to defer to you. Would you rather handle the mandates first or the EHB benchmark plan first? Mandates first. All right. Just wanted to make sure how you wanted to handle those and defer to you on that. So we will start with number 3 on the agenda, how to read and understand KRS 6.948 health mandate and federal cost defrayal impact statements. Wanted to do this for the committee so that everyone kind of had an idea of how these statements operate. These statements are something that we mandate in statute, and they are there for each of us and the other members of the General Assembly to be able to have a true analysis of the discussions and the decisions that we are having related to health mandates as those come up before us. Commissioner Clark can tell you a lot more on that history. She's been around a little longer than I have on that issue, but those mandate statements have changed over the last couple of years, some by legislative fiat when we added the Defrayal statements a couple of years ago, but also just updating by the actuarial firm that they hire to do those statements as well. And so I thought it would be good for the members of the committee, since we have new members of the committee and new statements, to just get a primer on those as we move into the session for next year, and everybody is fully aware of how these operate and be able to answer your questions so that you can make more informed decisions on those health mandates as they come before us. So I will turn it over to you, Commissioner Clark, if you would introduce yourself and your guest for the record, and you may proceed.
Thank you, Mr. Chairman, members of the committee. I'm Sharon Clark, the Commissioner of the Department of Insurance. I have with me Sean Orm, who is with my office, and also online we have Tracy Hughes, who is a contracted actuary with the department. Yes, you are telling my age, Chairman Meredith, but I was around then. The health mandate statements were first brought into law in Neural Statute in Chapter 6 in 1998. And let me tell you why they came about. Up to that time, you, as community members, would sit here and people would come before you to testify asking to add certain coverages to health insurance. You would ask the question as legislators, being responsible, how much is this going to increase the cost of health insurance? And quite frankly, you were frequently told just pennies a month. Well, we found out that wasn't true. So the commissioner at that time, George Nichols, made the proposition, and you all put it into statute, that the Department of Insurance would do an actuarial review of any health mandate statement so that you would have the information, should the bill come before you, that you could make an educated vote. Also, it gave the sponsor of the bill or any amendments the information as well, that they knew what they would be giving before for the consideration. So that's the brief history on it. Now, the health mandate statement, there's 3 requirements, and like I said, it's in Chapter KRS 6.948, and the 3 requirements to be included are the increase or decrease in the administrative expenses to the insurers offering it, the increase or decrease health benefit plan premiums in the markets, and the impact of the total cost. Now, frequently you will see this listed as maybe 25 cents PM. That means it would increase by 25% per member per month. So if you see that acronym, that's what it stands for. The health mandates have been around for, like I said, since 1998. In 2004, Chairman Meredith sponsored House Bill 186, and it reaffirmed the requirements of the health mandate statement. But it also added language about the cost of frail. So let's talk about that a little bit. When the Affordable Care Act was passed, the states were directed to determine the essential health benefits that would be offered to its residents. That was a choice made up to each of the states. I was the commissioner back when the Affordable Care Act passed, so I was very involved at that time. If there are any mandates, the federal law also, and I can give you that quote, the federal law also required that if there were any mandates that went above and beyond the essential health mandate statements, the state government would be responsible for that cost. The Defrayal costs would go back to state government. Quite frankly, during my first tenure as commissioner from 2008 to 16, I talked about cost of frail, and I think a lot of legislators thought I was crying wolf, that, there was no such thing. Well, it came home to roost in Kentucky in 2023 when there were two bills that were passed by this legislature that triggered the cost of frail. And at that time, Chairman Meredith got very involved. He educated himself on this. I met with leadership in both chambers, and we had a discussion. Your chair of the A&R committee was concerned about it because he asked me the question. He said, Commissioner Clark, how much is this going to cost? I said, I have no idea. It's going to be whoever uses it that year, and we'll get the bill the next year for it. So again, that can be rather alarming if you are in charge of coming up with a 2-year budget. So Chairman Meredith included the language in House Bill 186 that no mandate could go into place unless it was included in the essential health benefits of the state. Now, we are going to address that in just a few minutes. But right now, I'd like for Tracy just to briefly go through the health mandate statement. I think we've got one available that you all can see what it looks like, and she can tell how they analyze it. So, Tracy, we'll try to be succinct.
Yeah, we do have, if you look in your packets, we do have a fiscal impact report on BR 82 or Senate Bill 93, House Committee Substitute 1 from the 2025 session. So if you pull that out, that's what Tracy will be kind of walking us through the procedure on.
Thanks, everyone. Are you able to hear me?
We can, Tracy.
Okay, great. I'm going to try to also share my screen here. Can you see what I'm sharing there?
We can.
Okay, great. I just wanted to you to be able to follow along where I'm at in the report as I talk through it. So this report for the last or most recent fiscal impact report that we've done was chosen to go over with you as an example. You can see here in the title that it includes several coverages: hearing aids, cochlear implants, and feeding and eating disorder treatments. So this is a bit of a complex one. So as Commissioner Clark said, we're going to try to keep it a bit high level and not be repetitive with some of the extra that's here. Usually in each report, there's usually one, maybe two coverages that we're discussing potentially mandating. But as we go through, so the formatting kind of goes through each section. We start with an introduction. This first paragraph, we sort of try to give our most succinct summary of what the bill is proposing to mandate. Again, there's several bullet points here as there's several items being potentially mandated. Then we go through a brief summary of the statute that requires us to do a fiscal impact statement and what that should include. Commissioner Clark sort of went over that earlier, but some of the more recent Additions have been this supporting documentation, also the estimate of potential cost savings, and that along with the following Defrayal requirements that Commissioner Clark also mentioned, definitely instigated us to reformat the way we do this report into something more robust than we had done in prior years. In regards to the Defrayal impact, I would just note that it requires us to make a determination whether or not a mandated health benefit may result in Defrayal costs. Quite frankly, the guidance on what does and does not result in Defrayal costs to the state is a bit ambiguous and sometimes, in the gray space, if you will. So we sort of do our best to interpret whether or not something will result in Defrayal, and if we have any reason to believe that it might, that is our statement, that it may result in Defrayal. And you'll see when we get to an example of the statement later that we just state, ultimately this is up to the purview of CMS. And if the bill were to pass, it would likely result in several back and forth conversations between ourselves and CMS to figure out whether something rightfully does result in Defrayal or does not. So in 30 days, a short time period, we just sort of do the best we can. Then there's also a statement that these Defrayal or fiscal and Defrayal impact statements do not include the KEHP, the Kentucky State Health Plan, and the Medicaid program in Kentucky. These two entities have their own means of fiscal impact statements. We then go into the administrative expense impact. I don't want to say never, but off the top of my head, I can't remember the last time we've put a material impact to administrative expenses. Almost always we have no basis to believe that any singular health benefit mandate would materially alter administrative operations for insurers as far as claims adjudication and so on. So without any basis for that, we put an immaterial impact. For the premium impact analysis, we first start with claim cost calculation for the impact. You'll note this sort of introduction to this section sort of prefaces that we do a low range number and a high range number, or you might even call them a low endpoint and a high endpoint to create a range of potential impacts. Of course, we don't have a crystal ball, and so we want to make it apparent that this is an estimated range of where we believe this could fall based on the data we have available regarding the coverage. So in this case, this is sectioned into hearing aid and cochlear implants, and then there's a whole sort of repetitive section on eating disorder. So again, I'll try not to be repetitive here. So with the hearing aids and cochlear implant, or regardless of the benefit, really, you'll usually see a utilization pre-mandate section. And we always, and at least in this format that we use now, we always have our footnotes of any publicly available sources that we use to come up or use as the basis for this range. And in the rare cases that we don't have any basis or data, publicly available data, we will note that it's based on our actuarial judgment. You'll see this with the next section on induced utilization. There's often not any specific information available in regards to certain mandates and how much utilization it may induce. Induced utilization means, for example, in this mandate, the coverage was going to be mandated with no cost sharing to the member. So that in some cases, that is assumed to incite or induce some utilization, because where there was some member cost sharing, there may now be $0 member cost sharing. And so again, we just sort of do our best with our actuarial judgment, and in some cases, if it's an item like utilization that we're lacking data, you may see a larger range from low to high to reflect that greater amount of uncertainty. So we've got a utilization, induced utilization, then you'll usually see a unit cost. That's the cost of the benefit each time that it is used. These next two are a bit unique to this specific coverage. The hearing aids, we had prevalence initially, so we divided it by the lifespan of the hearing aid. And then also you can be up to 2 hearing aids per person. So we wanted to reflect the average between 1 and 2 hearing aids. And then you've got pre and post mandate cost sharing. So again, in this particular mandate, it was mandated without cost sharing. So it went from 50 to 70% cost sharing to no cost sharing for the member, which said the other way is 100% cost share for the insurer. And then we sort of put all of those pieces together. I don't know that I want to get too nitty gritty in the math here, but you can see each item here is labeled with a letter. And when we get to a calculation such as the per member per year, that PMPY here, you can see we sort of delineate the formula and the math we did to get to that number. In this case, we have several. So again, that gets us to the claim cost. We have several different tables here for claim costs because the numbers were different for children versus adults. Usually we only have one table here, and then we get into the premium impact calculation. This starts with the claim cost impact. And then uses the loss ratio, the average loss ratio, to get to a premium for both the total dollar amount and the impact of the mandate. And we also put that as a percentage. And then we take the member months and multiply the per member per month dollars by the member months to get the total annual impact. For this particular mandate, we sort of repeat that, rinse and repeat for the feeding and eating disorders. So again, you'll see utilization. In this particular one for eating disorder, the mandate was about prior authorization denial rates. So it was that a health plan could not deny a claim based on a certain criteria. So a bit unique here, instead of induced utilization, we discussed the change in denial rates expected from the mandate. Then you see the unit cost, the cost sharing component, and then again, we put these all together to get a claim cost impact, both on a PMPM and percentage basis, and then use the loss ratio to gross that up to a premium impact, both on a per member per month percentage basis and a total dollar amount when multiplied by member months.
Tracy.
In this case, we sort of summed all that up. This is not a typical section that we use because typically we're only looking at one mandated coverage.
Tracy, it's Sharon. Can I stop you there?
Please,
Okay.
please, yeah.
And if I can, Mr. Chairman, this is a very complicated bill. And as you can tell, this is a very complicated procedure to go through. I will tell you that last year in the short session, the department reviewed 39 health mandates, because each time, and I might do this at the stage, a legislator might have an idea, and they talk with the staff here, and the legislation is sent to me prior to even being filed. They ask for a health mandate. I send it off to our good friends Tracy and her co-workers at Lewis and Ellis, and they come back with their results. That legislator might then choose to, well, I want to tweak that some. So it might get sent back. The same legislation might be sent once again. Then, anytime after it's introduced, and that's when it becomes publicly available, I have to keep all of this confidential, we can have amendments filed. So as Tracy was talking about, on Senate Bill 93, this one that we've just looked at, is the House Committee substitute because the eating and feeding disorder language was added to it. So that's why this one in particular is so complicated. So it goes back and forth, and then the health mandate statements, are then, they are what they are. But that's the background on it. I don't know if any of you all want to get into actuarial questions. I don't have those off the top of my head. I will tell you that Lewis and Ellis, Tracy's firm, has worked with the department probably for, I would say, 20 years. They know the Kentucky marketplace intimately, which gives us a benefit. They also work with numerous other states. So that's pretty much on the health mandate statements. Now, why did we want to go over that? Let's talk about the next phase of this presentation today, and that's the essential health benefits.
Commissioner Clark.
Yes.
I do think I've got a question that may be technical related to that. Can we go ahead and get that before?
I'm impressed. Go ahead, Chairman Meredith.
Representative All.
I think the chairman was giving me too much credit. It's not that technical, Commissioner. Appreciate your work. Appreciate the explanation. I do have a question for you or the presenter. When we do this, every time we propose a bill, even if it's not filed, if I heard you right, even if it's a BR and we're thinking about it, we get this work and this background to see how much it's going to cost. My question is, how much does that cost the Commonwealth? Because these good people there are not doing it out of the kindness of their heart. They have to make a living. This is their job. So each time we send this off, how much does this roughly cost us to figure out how much it's going to cost us?
It costs the Department of Insurance. We pay for this totally. We do not have an appropriation for this. There's no reimbursement from the LRC. It's totally at the cost of the department. And again, it comes back to the complexity of it. There have been some years probably where I've spent $100,000 on this. It depends on the actuarial time that it depends. I said there were 38. In the 2024 session, I think we reviewed 55. So it's a load.
It costs them, Mr. Chairman. And so if we continue down this path, and I'm not saying these bills are good or bad. I mean, I voted for it, so I think some of these are good. So I guess my other question is, if it gets to be so much to where it's more than $100,000, would you increase your licensing cost to cover that? How would you cover if it got higher than you would expect?
And we just ask for additional appropriation. We bring in enough money that I can absorb it, but I have to come before the Contract Review Committee and ask for increases. But I am not complaining about the cost. No. I think it is well worthwhile for you all to have the accurate information that what you're voting on and what it means to the Commonwealth of Kentucky. The other thing I want to emphasize to you all, and it's hard to believe, we have a population of 4.5 million. There are only about 330,000 people in the commercial market that I regulate. So when a health mandate is passed in Kentucky and you think that it's going to be available, to everyone, that's not the case. We have a huge population in Medicaid, and we have a huge population in what our ERISA or the self-insured market. So it's always kind of a misnomer, and I think that a lot of people, when they hear about, that's going to be a new coverage for me, that's going to be available, that's not really the case. These are applicable to the private marketplace.
Commissioner, I did have a staff question related to the way those bills are paid. So are those paid per request for a mandate? Is it mandates come at different costs depending on the complexity of the bill that they're looking at? How do they bill you, I guess, is a little bit of detail on that.
each of our actuaries, and we have actuaries for other areas of lines of business, for property and casualty and whatever. When we ask them to do work for us, they bill us on an hourly basis. And it depends on also the level of, it might be a senior actuary. There can be some variances in the personnel there. But those bills come to me and to the department on a monthly basis, and then we pay them. They never come to you all or to the general fund or anything. So, and also the firm, we review every health insurance filing that comes into the state, whether it's on disability, if it's on cancer, any of that. We also have those reviewed. And again, those are at our expense. So if you ever look at the department's budget, I've got some pretty hefty figures in there for contractors, but it is necessary. And it's not just in Kentucky. States do this across the nation.
Thank you, Commissioner. And any other questions before we move on to the next part? Go right ahead, Commissioner.
Okay, I'm going to turn this part over to Sean Orm with my department to discuss after the health mandates were passed. And remember I mentioned 2 in 2023, and then there were some additional health mandates passed in 2024 that would trigger cost defrayal. So at the language in the bill, we asked CMS if we could have a waiver. That was an in-person meeting that we had with CMS, and they declined that. So in following the language of the bill, we have proposed changes to our essential health benefits. So, Sean.
Good morning, everyone. So the bills that have passed that have mandated the coverage that we look to add to our essential health benefit plan were the elimination of speech therapy visits, and this was caused by Senate Bill 111, that eliminated visits for speech therapy for treatment of stuttering. We couldn't just point to stuttering, eliminating the visit limit for them. We had to do it for all of speech therapy because there's certain discriminatory requirements under the federal law. So we just eliminated the visit limit for all speech therapy. We also proposed to expand coverage for cancer screening, and this was House Bill 52, passed in 2024, that required coverage for all cancer screenings consistent with nationally recognized clinical practice guidelines. The third request was biomarker testing coverage, and this was pursuant to House Bill 180, passed in 2023. The fourth was coverage for infertility, preservation of eggs and sperm that result from treatment for such things as cancer that may cause infertility, and that was House Bill 170, passed in 2023. We also initially included routine adult dental because there was a federal regulation passed that said states could add that to their essential health benefit plan if they amended their essential health benefit plan. So we took a look at all of these. Tracy had to perform an actuarial memorandum, which she did that. And we posted that information on our website pursuant to the federal requirements on February 5th of this year. This allowed parties to comment up through April 5th. We received comments on those proposals. After reviewing the comments and considering the projected cost, we decided to remove the routine adult dental request because that was estimated to cost the member $15.38 per member per month. So because of the cost prohibition of that, we decided to remove that request. We submitted the final application to CMS on May 5th of this year, requesting the 4 additional coverages. As to date, we have not heard anything back from them on when that may be approved or considered. We have to file the application 18 months in advance. So if it's approved, these requests will go into effect on January 1 of 2027. So if there's any questions, I'll be happy to try and answer them.
And I might add, when we look at these, when Tracy, we had to do a market survey of our current health insurers. We had to get what we call the floor and ceiling. So when mandates are passed, we cannot go above that ceiling. And so it was a lot of work. They had to acquire a lot of data from various health insurers and analyze that. And Tracy That's a good segue if you want to briefly go into to that.
Yeah, so there's what's called, let me see if I can share my screen again. I need to select a what the regulation calls a least generous plan and a most generous plan to create this floor and ceiling. And they're selected based on the original 10 options. Let me see if I can. Yeah, the original 10 base benchmark plan options from the 2017 plan year, and then also the current largest health insurance plan by enrollment within one of the 5 largest large group health insurance products, et cetera. There's several stipulations, as you can see here, but in comparing all 11 of those options, whichever one is valued at the least amount and whichever one is valued at the highest amount, or excuse me, it doesn't have to be the lowest and the highest, but whichever one is selected will be the lowest, the floor, and will be the ceiling. So most states try to do their best job to pick the lowest, what they believe is truly the lowest value, and what is truly the highest value to create the most room for flexibility there. And so, as you could see in our report, we compare the proposed benchmark to the least generous, just in regards to the benefit differences between those two plans. So the proposed benchmark was $1.85 higher than the least generous plan, so it was above that floor, and then it was let's see, about $44 PMPM lower than the most generous plan, so below that ceiling. Do you want me to go into anything else, Commissioner Clark, or was that the main thing you wanted me to explain?
Well, I think if you're available I want to be cognizant of time, Tracy, if you're available for questions. So
sure.
I guess my takeaway that I'd like for you all to have from this is that the health mandate statements, are required by statute, that we are doing a careful analysis. I will give our actuaries credit. Statute says we have 30 days to review these. Quite frankly, you all get a little impatient, and sometimes you'll send them to me, and 3 days later I'll be getting, where is that, Commissioner Clark? Well, we're getting them, but I think you can see from this, it is a very complicated procedures and requirements that they have to go through in preparing them. So we will continue to provide all the assistance and all the information we can for you all going forward. But I do want you to realize that any health mandates that you all pass here has a very limited impact on a number of limited Kentuckians. And that if we do end up triggering the cost of rail and we have to go to the essential health benefits, we have to go through a 18-month process with the federal government and get their approval. And that is never assured. So it's lengthy work. So, Chairman, I hope that provides all the information that you wanted, and we're available if you have any.
I'm going to open up some questions real quick, Commissioner, but if you could, and this was something that I didn't fully understand probably when we started going through all this work over the last couple of years, but you and I have had significant discussions about. Explain just a little bit about when we added the new mandates, or when we proposed the new mandates to the EHB, there was some leeway where we had the ability to add new things in there, but we are nearing a threshold that could then trigger Defrayal, and we do have to be cognizant of that as we move forward with mandates. Just explain that just a little bit, and then after that I'll open it up to committee members for questions.
Yes, sir. Like I said, we have a ceiling, so we have to stay within that ceiling of the amount of benefits. And let me just give you an idea of why, the elimination of the speech visit, that's going to be $1.50 per member per month. The infertility preservation, That is estimated to be 5 cents per member per month. Cancer screenings, 30 cents per members per month. The dental services was going to be $15.38 per member per month. And if I had added that, or if we requested that, that would have put me above that ceiling. Okay? If there are mandates, and again, this is your all's decisions, if you all pass mandates that are very costly or that get us above that ceiling, at the Department of Insurance, a decision has to be made. Well, what do we now take off? What do we eliminate? Okay? That's a hard decision to make, and I'm going to be probably coming back to you all. You want to include ABC, let's do that extra coverage. Well, it might cost another $20 per month, put us over that ceiling. Am I going to take away pediatric care for children? Am I going to take away this? What are we going to do to get us back within that range? So that's another consideration that you have to have that. And I know that we have a lot of need here in the state, but there is still, we have those requirements. Does that answer your question?
I think it did. Got a question from Representative McPherson, and then anybody else got questions, just so I can get you on the list.
So right here.
Representative McPherson,
Yeah, sorry
go
about
ahead.
that. Yes, thank you, Chairman. So feeding and eating disorders, I didn't hear that mentioned. Is that something that's been taken off the list, or is it on the list?
Sir, to ask for essential health benefit, it has to be a piece of legislation that has passed in the state. I do think that legislation did not pass in the last session, so we could not request that inclusion with our changes to the essential health benefits.
Okay, thank you.
Any other questions before we move on? Seeing none, Commissioner Clark, thank you to you and Sean. Oh, do we have one over here? Representative Duval.
Thank you, Mr. Chairman. I noticed that you mentioned that the estimate of potential cost savings for the future is discussed in the document. Is that included in the final number that you're coming up with, or is that just a separate number?
Tracy, you can give the technical answer, but Representative Duval, I've never seen, that's ambitious and hopeful language. If a health mandate is going to decrease the cost of your premium, I've never seen it happen. And Tracy, I don't know if you want to elaborate a little bit further, but
yeah, definitely this is something that with the update in the statute, we elaborate on more in the format of our fiscal impact report. We definitely always put forth any sort of high-level research or anything that comes from experience as far as what saving could be potentially achieved. However, it's usually very hard to find any data or studies done on the magnitude of such cost savings, how it nets out the cost of the benefit versus what it saves. So a lot of times we are not able to have any basis for a material cost savings. Even in the case of like cancer screenings, for example, also you have to consider the timeline of the cost savings. It may not be immediate, and maybe years down the road. And again, there's no succinct data or consistent data on whether or not a net savings is actually achieved. I do know there was one mandate impact statement this past legislative season where we were actually able to find a study on potential cost savings. And yes, we did include that in our section on the total cost of healthcare impact. So that piece of the report will include, if we are able to find any, in the rare cases we are able to find any data on it, we would include the potential cost savings. That mandate or that bill was the alternative chronic pain treatment, HB 506 from this past legislative season.
Thank you.
Any other questions from members of the committee? Seeing none, again, Commissioner Clark, thank you. Sean, Tracy, appreciate you all for I know there was a lot of information there, but the more you know, the more you can dig into these as we move forward into the coming sessions. So hopefully you will find this helpful as members of the committee. Thank you all very much.
Thank you, Mr. Chairman. And if we can be of assistance to you all, please contact us.
Next, we will move into proposed health insurance legislation for 2026. These are bills that were filed in 2025 or in previous years that had not gotten a hearing at some point in time just to discuss as they move forward, because they are things that I think sponsors have commitments to bring back for the next year's session. We will start with Representative Moser. If she would come forward, bring her guest, please identify yourself for the record. We've got about 20 minutes, so I'm going to try to tell you all to try to be succinct in your comments. We'll try to keep around 8 to 10 minutes for each of you all for presentations and questions, so try to keep it tight for us. We did have a busy agenda today.
I appreciate that, Mr. Chairman. Thank you very much for allowing us some time. We will be as brief and succinct as possible. I am Representative Kim Mosier. I represent the 64th District, and I will allow my guests to introduce themselves.
Good morning. I'm Dr. Leslie Eslam. Try that again. Good morning. I'm Dr. Leslie Eslam. I'm an adult psychiatrist and a child and adolescent psychiatrist, and I'm the Director of Behavioral Health at Sterling Healthcare, which is a federally qualified health center, and it's based in Mount Sterling.
Good morning, everyone. I'm Rebecca Red. I'm an LCSW, or a licensed clinical social worker at Sterling Health with Dr. Oslam.
Okay. Well, thank you. House Bill 78 was the bill that we filed last year, and this BR is very similar. There was a small change that the Department of Insurance wanted to make to ensure that this could be implemented. So we're talking about a psychiatric collaborative care model this morning, and I'll talk a little bit about some of the reasons that we feel this is necessary. We know that Kentuckians are suffering from mental health issues and that they need better and sometimes immediate access to mental health services. And they're oftentimes presenting to their primary care provider with those mental health issues. They don't have ready access to a psychiatrist, and so that's what this would encourage. This also requires that mental health services are covered on par with any other medical treatment as per the Mental Health Parity Act, which we passed a few years ago in alignment with the federal Paul Wellstone and Pete Domenici Mental Health Parity Act of 2008. This proposed psychiatric collaborative care management model will allow for behavioral health care, which is integrated into primary care, and the care will be consistently covered across all health benefit plans. The collaborative care model, Dr. Aslam will talk about why this is a better approach to patient care in a minute, but this is a specific approach that has demonstrated meaningful success for patients. It is a team-centered and evidence-based approach to care that keeps providers accountable for quality, and it integrates care across all providers, patients, their families, and communities. The collaborative care team is led by a primary care provider and includes a behavioral health care manager and a consulting psychiatrist. This would retire the current pay structure, which is a flat rate or a flat fee for each individual service. That is HCPCS code GO 512, and it replaces it with established CPT codes for collaborative care. I won't go through each CPT code unless there are questions, but this current flat rate structure does not account for the varying levels of complexity and intensity required in and involved in providing collaborative care and psychiatric services. Just a last couple of notes. Research. This collaborative care model has been carefully researched. It is evidence-based, and it has been piloted and shown that the collaborative care model has proven more cost effective than treatment as usual, saving $6.50 in US dollars in healthcare costs for every $1 spent treating depression. The proposed change represents a critical step toward creating a more sustainable and equitable framework for federally qualified health centers and rural health clinics to provide high-quality, integrated behavioral health care. And so simply moving away from the flat rate approach will allow for more flexibility and responsiveness to patients who are requiring the services for mental health care. And I would just add that we have seen an explosion in the need for mental health services. You turn on the news every day, and you can see that we are not meeting the needs of patients. Partly this is a workforce issue, but this would extend that workforce and encourage better treatment. So I'm going to hand it over to Dr. Aslam now.
Hi, yeah, good morning. I first want to clarify, at Sterling Health, we don't officially practice a collaborative care model because it's cost prohibitive. We would like to. What we offer is basically integrated healthcare, where we try to integrate behavioral healthcare into primary care, because we know that most people don't just show up at a psychiatrist. They go to their PCP, their primary care provider first. So as Representative Mosier alluded to, I'm sure you've noticed, if you watch the news, the people are not well. We have a mental health crisis among the youth. I could talk about that for a lot longer than you guys have. But adults as well are not well. 76% of people are living paycheck to paycheck. That matters. That, if you can't sleep at night because you think your electric's going to turn off, me throwing some medicine at it is not going to solve the problem. But what we're seeing is people showing up to primary care desperate for help. And what we're also seeing, and one thing that I think is not included in a lot of this research, is primary care burnout. So I'm sure maybe some head nods if you guys have heard of primary care physicians or primary care providers suffering from record high burnout and a lot of turnover in the primary care space. That is because they're being forced to deal with problems that are way out of their scope. They're not psychiatrists. They didn't train to do what I do, but patients are showing up desperate for help, and they don't have the resources unless, they practice someplace like Sterling Health or places that have integrated behavioral health care. They are basically saying, gee, I'm sorry. Maybe if I throw this medicine at you, you'll feel better. Come back in a month and we'll see. And as it should come as no surprise, that's not terribly effective treatment. So what I like about integrated healthcare, but specifically the collaborative care model, which is the one that has been the most well studied, has the most evidence backing it. It does, we know that it reduces costs. That's always something I know you guys like to hear. It also reduces the stigma associated with behavioral health care. If people have to go to a separate building, a separate facility to go see a therapist or a psychiatrist, they're less likely to utilize it. And it also really improves PCP burnout. They really, that's one of the major attracting factors for primary care providers to come work at Sterling Health, is they love knowing that they have that built-in backup. So when they're forced to deal with something that's technically out of their scope, they can say, whoa, hold on. This sounds really bad. I'm so sorry you're feeling this way. Let me have you go talk to Rebecca. Let me have you talk to somebody this is in their wheelhouse, and they can get you started on the right path. So really what collaborative care allows you to do is a lot more effectively and expertly triage patients. We have, a wide range of acuity. We have people showing up who are flagrantly psychotic. Their family members can't get them to sleep. They've been awake for 4 days. They're talking nonsense. That happens, not irregularly. And then we also have people who just kind of have indolently been going along, have depressive symptoms that are affecting their functioning, but not to the extent that they sought psychiatric care. That's a huge range in what that patient, the patient who's just suffering some minimal depression probably could just meet with PCP, maybe a behavioral health consultant 1 or 2 times, be on their way. Somebody who's flagrantly psychotic obviously needs to come see me pretty quick. But if we don't have the tools in place to triage, and if we're not being reimbursed for that, then basically patients everyone gets shuttled to the highest level of care, and it's unnecessary. It's wasteful. Trying to keep it brief.
I appreciate it.
What's your number? I might need to
I charge a lot. No, just kidding.
So we're happy to entertain any questions at this point, unless, do you have anything that you'd like to add? Okay.
Any members have questions? Representative Smith.
Real quick, Mr. Chairman. Representative Mosier, is with all your background in dealing with all this. In my area, a lot of discussion in the last few years has been schools with mental health, and my superintendents tell me that 25% of their kids could fall in the spectrum. Are we missing out by not identifying at an early age this condition? I know nationally we see a lot of things happening with that's not good.
Yes.
Are we missing out by not identifying them, identifying kids at an earlier age? I know we talk about education, we talk about starting them earlier, doing all this, but are we not missing out by not testing, identifying? Is that something you could comment? I'm not trying to take up a lot of time on it.
No. I'm happy to talk about that. Yes, I absolutely agree that we are missing opportunities to either prevent mental health issues in our youth, and there are a lot of reasons why this happens. Dr. Aslam talked about poverty, but I would like to talk about social media and the technology that kids are faced with on a, if not a daily basis, and hourly. Sometimes, I mean, it's a constant
24/7.
influence, right? So I think that's a big part of the problem. We do have school-based health centers, and in some, we heard last month or a few weeks ago in health services about a school who is utilizing this service really well. I think that we can really expand that, really look at what those services are that are provided. If testing is identified as a need, that should be part of the identification might come from the school-based health center and then a referral to the primary care office. And if we have some integrated care, then it can all take place in a setting that the family and the patient is more comfortable with, and we can encourage providers to actually provide the care by being compensated. And it's almost a shift in the way that the payment would be received. It's not a big increase. It's just addressing varying levels of care that are needed. So yes, I think we are not thinking upstream enough about what the causation and potential prevention services are that we could be offering. We're getting better. We're starting to think about that. But it's going to take all of us to provide those services and work with families.
Mm-hmm. Senator Elkins.
Thank you, Mr. Chair. Senator Carpenter, I will say I've been to Mount Sterling where the services are performed, and I highly recommend it. But I just want to say, and I don't have a question, but I want to say thank you, Representative Mosier, for bringing this bill forward. I have been to CHI St. Clair or at St. Joseph, and I do understand what they're doing. I see the importance and the need for having those services in the same location as the primary care physicians are, and I do support it, and I thank you for bringing it.
Thank you very much.
What's it? Yes, ma'am.
Oh.
Did you have something else that you wanted to add?
Oh, not necessarily. I was going to say co-located is great, but co-located just makes people feel more comfortable to be there, but it doesn't actually cut costs. That still has a lot of people unnecessarily shunted off to specialized behavioral health providers as opposed to staying within primary care. So the beauty of the collaborative care model is it actually allows a lot of patients to stay with their primary care provider just with some additional help. And that cuts a lot of costs because I'm a specialist and PCPs are not.
Thank you all very much. Representative Fleming, if you would bring your folks up, go ahead and introduce yourselves for the record. Proceed. Again, try to keep it as brief as possible. We are running on a time crunch right now, trying to get everybody fit in.
Well, thank you, Mr. Chairman. Appreciate the opportunity. I'm Ken Fleming. I represent the 48th District, which includes part of Oldham County and Northeast Jefferson County. And I'll let my guest introduce herself, too.
Hi, I'm Dr. Andrea Krause. I am a professor of pediatrics, a pediatrician working through Norton Children's Medical Group with the University of Louisville School of Medicine, and I am the past chair of the Kentucky Eating Disorder Council for the last 2 years. I know I have to keep this brief because you're running low on time. There's some facts there about the Kentucky Eating Disorder Council that are included in the packet. And some just general facts about eating disorders in Kentucky. A few specific things to talk about regarding eating disorders. It is the second highest mortality rate for any psychiatric illness, only overshadowed by substance use disorder. I think you all are probably aware of those facts from our work with the council in the past. It is a debilitating diagnosis that can kind of occur over the course of 10 years. It can be chronic and relapsing. It's a very costly diagnosis, estimated to cost $64.7 billion annually in the nation. And then, definitely there's an under-recognition of those who have eating disorders. Likely only 20% are actually captured and treated for the illness. And it does require a very multidisciplinary team, dietitians, physicians, counselors, therapists of a variety of types in order to get someone into recovery. So the reason I have an interest in it is because this is my patient population. I treat pediatric patients with eating disorders that are hospitalized at Norton Children's Hospital. So the bill that we have proposed is regarding body mass index, and just a quick primer on that is just a quick calculation. It's really not that fancy. It's a ratio of your weight to your height. That's all it is. And so it does not take into account factors such as your skeletal mass, if you have like a large skeletal frame, for example, or if you have a high muscle mass. It can kind of alter the BMI and make it maybe higher than it appears. And then it is commonly used as a marker for wellness. And this can be the case whether this is obesity medicine that we're talking about or in the treatment of eating disorders. And I think it can be a real barrier when you're approaching illness like that. And so with the House bill that was proposed back in the early part of the year and now BR 467, we would basically ask to have health plans cover eating disorders irregardless of like the BMI. So would not allow them to limit coverage just based on this type of a measurement, the BMI or ideal body weight, or any other kind of like weight-based measurement. And that basically promotes the use of behavioral approaches to the illness, because those are better indicators for how sick someone is with an eating disorder. That's whatever their eating behaviors might be with the illness, how much supervision is required in order to get them better, labs, vital signs, those are better markers of illness. And then there's always co-occurring illnesses, anxiety, OCD, depression, and a variety of things, suicidality especially. So why we think this is necessary is because BMI use, it is estimated that 90% of people with eating disorders have actually a normal body mass index. And if some specific examples I have here are males, like males with eating disorders generally have kind of a normal BMI. And so looking at that number alone really doesn't give you the full picture. Atypical anorexia nervosa is an illness entity that is rising, and I'm seeing that in the hospital. People that come in with very normal body mass index. So, whenever you do the calculation, it looks pretty normal, yet they have lost a striking amount of weight. And actually they can be just as sick as someone, who has a BMI of, 10 when a normal BMI for, say, a female is like 22. But their vital signs can look just as bad. So, things to consider. I think this is helpful. This kind of legislation is helpful to try to lay the groundwork. In the state of Kentucky, we have a lot of limitations when it comes to treatment of eating disorders. And so I think this is one area that just kind of like lays the groundwork for better access to treatment and care. We got a nice intro, so I don't have to go into the details of this about the Kentucky benchmark plan, the fiscal impact report. I personally have the fiscal impact report here, although she showed it on the screen from March that included the hearing coverage as well. So it was stated that it was an immaterial impact. And so in the interest of time, I will leave room for
Thank you,
Representative Fleming.
Well, she did a lot of the ramp up for me, which was really good. But in a summary, Mr. Chairman and members of the committee, we did propose a bill last year, and I appreciate working with the chairman, going through that process. All we want to do basically is to not only have the BMI in there, but also mental health. This is a mental health issue as well as a BMI. My understanding is that the exclusion of of eating disorders have been taken out of the plan, which basically goes you into a default mechanism or default process in terms of this is a mental health issue, and that's covered under the plan because they've identified mental health in the plan and so forth. In order to do that, so what we like to do with this bill is just to codify, just to make it clear that when we go through and look at the coverage, that the BMI and mental health, which is an underlying main issue, I believe, is basically covered from insurance. That's all I have, Mr. Chairman.
Thank you all very much for being brief. Any questions from members of the committee? Seeing none, again, thank you all very much.
Thank you, Mr. Chairman. Thank you, Member Chairman.
Move on to our final topic on the agenda, coverage of hearing loss. Representative Heverin, if you and your guest would please come to the table. I think you've got some guests that are on virtually. If you all would please introduce yourselves for the record.
Hello, I am Samara Heverin. I represent the 18th District, and I will let my guests introduce themselves.
Hi, I'm Jennifer Hughes. I'm a constituent.
Hi, I'm Dr. Shelley Motes. I'm a pediatric audiologist with Norton Children's Medical Group in Louisville.
Please proceed.
Thank you, Mr. Chairman and members of the committee. I'm here to present on an act relating to coverage for hearing loss, which was Senate Bill 93. So I couldn't hear myself think because Representative Fleming had such good thoughts back there. So this is Senate Bill 93 from the 2025 regular session. I've talked with the previous bill sponsor, Senator Berg, and she was happy for me to take this on. Since Jennifer is a constituent, I also went to high school, and I've known Jennifer since grade school. She was a year older than me. And so because she's a constituent, Senator Berg was happy for me to take this bill. And I honestly, this passed the Senate 38-0. It made it through the House Committee for Health Services. But really, because this is a health mandate, I talked to Chairman Meredith about this, and I felt like it was a better fit to be in banking and insurance. And so Jennifer, who's here via Zoom, I'm going to let her talk. She is much more educated on this, as well as Dr. Motes. But I just wanted to be able to kind of set the table and share what was going on.
And I appreciate you all being on. Just again, try to keep it brief. We've got about 5 minutes. We're going to go over, but that's fine. But try to keep it brief, 5 to 7 minutes if you can.
Okay. Yes, can everyone hear me? Okay. So I'm Jennifer Hughes, and my 6-year-old son Everett was born with hearing loss, and I'd like to share our experience that we have been through as far as hearing aid coverage. So he received his first pair of hearing aids at 2 months old, and we realized how important they were immediately because he was finally responding to sound. His hearing aids have given him access to sound and music, the ability to interact with others, and the opportunity to be successful. Everett is now in 1st grade and is part of the primary talent pool. And if you're unfamiliar with what that is, it's a group of children who demonstrate performance at exceptionally high levels because they are able to learn and comprehend at a faster pace than their peers. And I give credit to his hearing aids that have allowed him access to sound, because without that access, I feel like he would have more difficulty achieving his full potential. So one of the challenges we've encountered as a family is inadequate coverage for hearing aids. Whenever it was 3, his audiologist recommended upgrading his hearing aids and recommended a pair that cost $5,000. Our insurance benefit at that time read that it would cover 50% of the allowable after the deductible was met, and then we soon learned that our plan's allowable for a hearing aid was $1,000, and it's common practice to balance bill the patient the difference in the cost of the hearing aid and what's allowed by insurance. So long story short, We paid $5,000, which was required upfront before he could get the new hearing aids. Only $2,000 of that went towards our deductible and out of pocket, and then insurance didn't pay anything towards the hearing aids. So I know in the analysis before it was estimating like pre-mandate insurance is covering 50 to 70%. I mean, in our case, and a lot of people that I've spoke with, it's not covering anything. I think part of the problem is current legislation doesn't set a minimum coverage. It says, up to $1,400 per affected ear. And that's where this bill will help set a minimum coverage to help with that cost of the hearing aids. So, and I guess I'll let Shelley talk.
Thank you, Jennifer. Can everyone hear me? My IT setup today is a little sketchy. I'm in a random room. So I just want to talk a little bit about what we see in the clinic as far as children who have congenital hearing loss. Each year, there's about 53,000 babies born in Kentucky, give or take, if you look at the last 5 years of birth records. About 150 of those babies are going to be born with permanent hearing loss that requires the use of hearing aids. Left untreated, these babies will experience significant impacts to their language development, to their future academic success, and to their social emotional development. Hearing aids are a really critical piece of that treatment, as Jennifer noted for her son. In 2002, Kentucky recognized the importance of this and passed a law requiring fully funded commercial insurance plans to cover a portion of hearing aid costs for children. Under the current law, most families that are using commercial insurance are 100% out of pocket on the cost of their child's hearing aids, simply because this well-intentioned law is outdated in the era of high deductible insurance plans. This translates to approximately $30,000 out of pocket on hearing aids alone for a child with hearing loss from birth through age of 18. This figure does not include the cost to families for evaluations and other medical appointments, repair and replacement parts for the hearing device, or additional support services such as speech language therapy. And for many Kentucky families, this is financially out of reach. We were so thrilled last year when Senate Bill 93 passed out of the Senate and passed unanimously out of 2 committees. And it was noted during that process that the fiscal impact was minimal, which Ms. Hughes supported today. So it was nice to get that level of detailed reporting. Updates to the current law would increase the coverage amount from up to $1,400 per ear to a minimum of $2,500 per ear every 3 years, provide for periodic review and update of the minimum amount by the Kentucky Commission for the Deaf and Hard of Hearing to maintain adequate coverage for hearing aids over time, and eliminate cost sharing for families. The fiscal analysis shared by Ms. Hughes, which was very detailed and probably a little more detailed than I can actually understand, but one thing that it did not capture were downstream savings in expenses outside of insurance costs, which could include savings in special education costs, disability claims, and unemployment claims directly related to pediatric hearing loss. I thank you all for your time today.
Thank you all very much. Representative Heverin, anything else?
Thank you, Mr. Chairman. I just want to add, I have been working with Anthem on this conversation. We are trying to figure out what the middle ground looks like. I appreciate Anthem coming to me and seeing what we can do to work this out and better understanding the issue. And so this is an issue I will continue to work on. I've never passed legislation on hearing loss or affecting the health mandate or the state health insurance mandate. I'm still learning about banking and insurance, right? We all are. And so anyways, I really appreciate them. This will be a conversation we have moving forward. And thank you to the committee for hearing us today.
Any questions from members of the committee before we dismiss Representative Heverin and her guests? Seeing none. Or maybe I do have one. Chairman Carpenter.
I reject any questions.
Maybe that needs to be handled offline. Seeing none, thank you all for the presentation. We appreciate you all being here very much. As a matter of an announcement, our next meeting will be held on October the 14th at 9:30 a.m. in this same room. Please be here in attendance. Seeing no other business before the committee, do I have a motion to adjourn? Motion by Representative Baumann, second. Representative Pollock. All in favor say aye. We are